Welcome to the deep dive. Today, we're looking at something pretty fundamental, actually. It's all about monetary policy in Australia. Think of it as the kind of hidden engine room that influences, well, almost everything. Your job security, the price of groceries you see every day.
That's a great way to put it. And the materials you shared, they really focus specifically on the Australian system, which is key.
Right.
We're not talking abstract economic theory here. We're looking at the actual levers, the actual goals that shape our financial world, right here at home.
Okay, so our mission for this deep dive is to really get into these sources, pull out the core ideas about Australian monetary policy. What's it trying to do? How does it actually work?
That's good.
Let's kick off with the big picture then.
Yeah.
What are the main objectives? What's monetary policy in Australia aiming for?
Well, the ultimate goal, the really broad one, comes straight from the Reserve Bank Act that's back from 1959, and also the more recent statement on the conduct of monetary policy. And it's all about fostering the economic prosperity and welfare of the Australian people, both right now and, looking into the future. That's the benchmark.
That sounds huge. Economic prosperity and welfare. How does the Reserve Bank of Australia, the RBA, how do they actually try and achieve that using monetary policy?
Yeah, it's broad, but it gets broken down. It really boils down to two key goals. They're interconnected, of course.
Okay, what are they?
First one is price stability, basically achieving low and stable inflation.
Inflation being prices going up generally.
Exactly. The general level of prices for goods and services increasing over time, keeping that increase low and, crucially, stable is really important. It protects the value of your money, your purchasing power.
Right.
And it also creates a more predictable environment for businesses, which helps support sustainable economic growth.
Makes sense. Is there a specific target number for this low and stable inflation here?
Yes, there is. The RBA aims to keep consumer price inflation, that's the one most relevant to households, between 2 and 3% on average over time.
2 to 3%.
And what's interesting is the flexibility. They specifically state they want inflation to settle around the midpoint of that range over the medium term, so around 2.5%.
Okay, so flexibility, but aiming for the middle. Got it. That's price stability. What's the second big objective?
The second one is full employment.
Full employment. Does that mean literally zero unemployment? Everyone has a job.
No, not quite. That's a common misconception. There'll always be some unemployment. People move between jobs, right?
Sure.
Or sometimes the skills people have don't quite match the jobs available. That's called frictional and structural unemployment. So full employment means creating an economic environment where basically jobs are available for pretty much everyone who wants one and is able to work without causing inflationary pressures. It's the maximum level of employment sustainable over the long run.
Okay, so keeping prices steady and maximizing sustainable jobs. That's the RBA's job. Now, who actually makes these big calls on monetary policy? Is it just one person?
No, it's the Reserve Bank's Monetary Policy Board. That's the specific body responsible for setting monetary policy in Australia.
The Monetary Policy Board.
And a really, really important point here is the RBA's independence from the government.
Right, you hear about central bank independence. Why is that considered so vital?
Well, it's crucial, really. It's a principle adopted pretty much worldwide now. It helps shield monetary policy decisions from, let's say, short-term political pressures or election cycles.
Oh.
It allows the RBA board to focus squarely on those long-term economic objectives: price stability, full employment without political interference. The board members, like the governor, the deputy governor, even the secretary to the Treasury sits on it. They're appointed by the government, but they make their decisions independently.
So this independent board, they're constantly juggling these two main goals, price stability and full employment. Sounds like it could get tricky, a bit of a balancing act.
You've nailed it. That's a core challenge. The concept of trade-offs is central.
Trade-offs?
Yeah.
How so?
Well, sometimes the actions you need to take for one objective might potentially pull against the other objective, at least in the short term.
Okay, give me an example.
Sure. Let's say inflation is getting too high, maybe creeping above that 3% target ceiling.
Right.
The board might decide to raise interest rates, specifically the cash rate target, which we'll get to. This makes borrowing more expensive, which tends to cool down spending and investment across the economy.
And that brings inflation down.
That's the aim, yes. But higher interest rates can also make businesses a bit more cautious. They might pause expansion plans, maybe delay hiring new staff.
So cooling inflation might slow job growth or even increase unemployment slightly.
Potentially, yes,
Yeah.
that's the trade-off. Conversely, if the economy is weak and unemployment is high, cutting interest rates to stimulate activity might risk pushing inflation up later on. The board has to weigh these things very carefully at every meeting.
It really is a delicate balance then, like adjusting controls where one affects the other. Now, the sources also mentioned financial stability. Is that a third objective? Where does it fit?
That's a great question. Financial stability isn't listed as one of the two primary objectives of monetary policy itself, in the same way price stability and full employment are.
Okay.
But it's absolutely critical and deeply connected. The RBA, and specifically the Monetary Policy Board, has a clear responsibility for fostering overall financial stability.
How does monetary policy link to that?
Well, think about it. An economy with low, stable inflation and sustainable growth, which is what monetary policy aims for, is generally a much safer environment for the financial system.
Right. Less volatility, less risk, maybe.
Exactly. It reduces the chances of major financial shocks. Plus, a stable financial system, banks lending confidently, people trusting institutions, is essential for monetary policy to even work effectively. You need banks to pass on interest rate changes, for example.
So they support each other. Does the RBA do specific things just for financial stability?
Yes, several things. One key role is acting as the lender of last resort.
Lender of last resort.
It means if a fundamentally sound, solvent bank runs into temporary trouble accessing funds in the market, the RBA can step in and provide emergency liquidity against good collateral, of course.
To prevent a panic or a bank run.
Precisely. It stops isolated problems from cascading through the whole system. The RBA also constantly monitors the financial system for potential risks, things like housing market bubbles, high debt levels, and they publish their findings in the Financial Stability Review twice a year.
Okay, that gives everyone a heads up on potential issues.
Exactly. Transparency is key there, too.
Okay, so we've got a good handle on what the objectives. Price
Right.
stability, full employment, supported by financial stability. Now let's dig into the how. How does this monetary policy board actually make its decisions and, put them into action?
Right, the process. It's quite structured. The board meets 8 times a year. Used to be monthly, now it's 8 times.
8 times a year. Okay.
And in these meetings, they undertake really in-depth discussions. They look at a huge range of economic and financial data, developments both here in Australia and overseas, because that matters too.
So it's very data-driven. They're not just guessing.
Oh, absolutely not. Leading up to every meeting, the RBA staff, the economists and analysts prepare detailed briefing papers. These papers analyze the current economic situation, the outlook, and, crucially, they usually contain policy recommendations based on all that analysis.
So the board gets expert advice.
Definitely. The board members then discuss these papers thoroughly, debate the issues, consider the different perspectives and risks, and then the actual monetary policy decision whether to change the cash rate or keep it steady is made by a majority vote of the members present.
A vote. Okay. And how do we find out what they decided?
Transparency is a big focus here. Immediately after the meeting concludes, usually around 2:3 p.m. Sydney time, the decision is announced publicly.
Right.
Yep. And then the governor holds a media conference shortly after to explain the board's reasoning, their view on the economy, and the outlook.
So we get the decision and the explanation.
And there's more. To give even deeper insight, the detailed minutes of the meeting discussions are published just 2 weeks later.
The minutes, so you can see what they discussed.
Exactly. What factors were weighed, what the different arguments might have been. Plus, every quarter, the RBA releases a comprehensive report called the Statement on Monetary Policy, which has detailed economic forecasts and analysis.
Okay.
And finally, the governor also appears before a parliamentary committee twice a year to answer questions directly from elected officials about how they're conducting monetary policy.
Wow. Okay. That sounds like a lot of communication and accountability built in.
It is. It's designed to make the process clear and hold the RBA accountable for its actions, and also to help manage expectations in the economy about inflation.
Right. Now, the actual tool, what's the main lever the RBA pulls to implement these decisions?
The primary tool, the workhorse of conventional monetary policy in Australia, is the cash rate target.
The cash rate target. What exactly is the cash rate?
It's the interest rate on overnight loans between commercial banks. Banks sometimes need to borrow or lend funds amongst themselves overnight to meet their daily settlement obligations. The cash rate is the market interest rate for these unsecured overnight funds.
Okay, the rate banks charge each other for super short-term loans.
That's it. And the RBA sets a target for this rate.
So they announce, say, we want the cash rate to be 4%. How do they make sure the actual rate banks charge each other hits that target? Do they just tell them?
No, not quite that simple. They use their own operations in the money markets to influence the supply of funds available overnight.
Oh,
Essentially, the RBA interacts with commercial banks through what are called open market operations. They might buy or sell government securities or conduct repurchase agreements. By doing this, they can inject funds into the system or withdraw funds from it.
so controlling the supply of money available for those overnight loans.
Precisely. By managing the overall supply of exchange settlement balances, that's the money banks hold in accounts at the RBA, they can ensure that the actual traded cash rate in the market stays extremely close to the target they've announced. They fine-tune it daily.
Clever. So the target becomes the reality through these market operations. Now, the sources mentioned the RBA has used some other tools sometimes, not just the cash rate.
That's right. Particularly during challenging times like the global financial crisis or more recently the COVID-19 pandemic, the standard cash rate tool needed some backup.
When the cash rate gets really low, maybe?
Exactly. When the cash rate is already near zero, lowering it further has less impact. So they've used what are often called unconventional monetary policy tools.
Like what?
One was forward guidance. This is where the RBA explicitly communicates its intentions about the future path of the cash rate, trying to influence market expectations and longer-term interest rates.
So telling people, we expect to keep rates low for X amount of time.
Kind of, yes. They also introduced a term funding facility. This provided banks with low-cost funding for 3 years, specifically to encourage them to keep lending to businesses and households during the pandemic uncertainty.
Okay, helping banks lend more.
And then there were measures directly targeting longer-term interest rates. They had a yield target for a period on the 3-year Australian government bond, aiming to keep its yield around the cash rate target.
Fixing a longer-term rate.
Effectively, yes, through bond purchases if needed. And alongside that, they undertook large-scale government bond purchases, quantitative easing, or QE as it's known elsewhere, buying government bonds across different maturities to put downward pressure on longer-term interest rates more broadly and support the economy.
So a bigger toolkit for unusual times.
Exactly. These aren't everyday tools, but they're there if needed to provide extra support.
Okay, so whether it's the cash rate or these other tools, how does changing these interest rates actually, ripple through the economy? How does it end up affecting my mortgage or a business deciding whether to expand?
The transmission mechanism. This is how monetary policy actually influences the real economy spending, investment, jobs, and ultimately inflation.
Okay, walk me through it.
So the RBA changes the cash rate target. Step 1. This change quickly flows through to other interest rates in the financial system. Like the rates banks offer on deposits, the rates they charge for housing loans, especially variable rate mortgages, and the rates for business loans. They don't always move perfectly in sync or by the exact same amount, but they generally follow the cash rate's direction.
Okay, so cash rate up, mortgage rates likely go up. Cash rate down, they likely go down.
Generally, yes. Now, these changes in borrowing costs affect the decisions people and businesses make.
How so?
Well, if interest rates go up, borrowing becomes more expensive. Households with mortgages might have less disposable income after making higher repayments. Businesses might postpone investment projects because the cost of funding them has increased.
So less spending, less investment.
Potentially, yes. Higher rates can also encourage saving because you get a better return. And it can affect asset prices like houses or shares, and also the exchange rate. All these channels work together to dampen overall demand in the economy.
Okay, so higher rates cool things down. And lower rates.
Do the opposite. Lower interest rates make borrowing cheaper, potentially boosting household consumption and business investment. People might feel wealthier if asset prices rise, encouraging spending. A lower exchange rate could make exports cheaper, boosting another part of the economy. It stimulates overall demand.
And this change in demand is what affects inflation and employment.
Exactly. By influencing the overall level of spending and activity in the economy, monetary policy helps steer economic growth towards a sustainable pace. The goal is to keep the economy from overheating and causing high inflation, but also to avoid deep downturns with high unemployment. It's about smoothing the business cycle, keeping things in line with that inflation target, and the goal of full employment.
Right, trying to keep the economy on an even keel.
That's the idea. The transmission process takes time, though. It can take, maybe 1 to 2 years for the full effects of an interest rate change to flow through the economy and impact inflation.
Okay, so it's not an instant fix.
Definitely not. There are lags involved.
Okay, we have covered a lot of ground here. Let's try and bring it all together. If someone asks, what's the deal with Australian monetary policy? What are the absolute key takeaways from our deep dive today?
I would say number one, the main goal is the economic prosperity and welfare of Australians.
Right, the big picture.
And that's achieved primarily through two key objectives: price stability, keeping inflation low and stable, aiming for that 2 to 3% target, ideally the midpoint.
And full employment, maximizing sustainable jobs.
Exactly. Number two, it's managed by the Reserve Bank's Monetary Policy Board, which operates independently from the government to focus on these long-term goals.
Independence is key.
Number three, the main tool they use is the cash rate target, influencing interest rates throughout the economy via market operations, though they have other tools for challenging times.
Okay.
Number four, they have to constantly manage the trade-offs between inflation and employment. And number five, financial stability is also a core responsibility, closely linked to their monetary policy objectives.
That sums it up pretty well.
Yeah,
And it's not some secret society making these decisions, right? We talked about transparency.
absolutely not. That's maybe takeaway number six. There is a high degree of transparency.
Right.
Regular announcements, the governor's press conferences, published minutes, quarterly reports, parliamentary appearances. It's all out there.
Yeah.
This accountability is vital, and it also helps anchor people's expectations about inflation, which actually helps the RBA do its job.
That makes sense.
Oh.
So perhaps a final thought for you listening.
Yeah.
These decisions about monetary policy, they might seem distant, made in boardrooms, but as we've discussed, they have a really direct impact on your mortgage, potentially your job prospects, the prices you pay, understanding even just the basics of how this works in Australia. Well, it makes you a much more informed observer, maybe even participant in the economy around you.
Definitely.
It really makes you think, doesn't it?
Yeah.
What role does knowing this stuff play in how we all navigate our own financial lives? Something to ponder. Thanks for joining us on this deep dive.